Hi folks, Stephen Ryan here from Stephen Accounting. So you're starting your own business. That's pretty cool. Thought I'd do a few quick videos on the most common questions and situations that come up. I live and breathe this stuff, but I'm only going to be scratching the surface. So if you want to know more, leave a comment, send me an email, I'll get back to you. Today's video is on structure. For most people, there's really only two types of structuring to consider. Do you want to formally register as a company, or do you want to be a sole trader? Being a sole trader means that you and your business are the same legal entity. If the business gets into hot water, it means you're in hot water. If you rack up a bunch of debt with somebody, most commonly inland revenue, then they can come after your personal assets. Registering a company, on the other hand, means that you and your business are separate legal entities. So, if your business can't pay its debts, then the people the business owes money to have options like liquidating the business to get its money out, but they can't come after your personal assets, like your family home. This doesn't just give you the freedom to just recklessly load up on debt and then say, haha, tough luck to your creditors though. As a director of the company, you have a bunch of duties that you need to comply with. They're all fairly common sense stuff, like don't do anything that's going to create a loss to your creditors, or make all your filings on time, act in good faith, etc., etc. If you breach these duties, then it doesn't matter that it's a limited liability company, your personal assets could still be at risk. If you do go with a company, you'll need to decide on what shareholding to go with. I typically recommend 120 shares because if you want to bring in more shareholders, then 120 is divisible by common number of shareholder types like 2, 3, 4, 5, and 6. So that's the first level of structuring. The next level involves trusts. Trusts are another entity that's legally separate from you. They used to be really popular because there was a misalignment in the trust tax rate and the individual's top tax rate, but that's been legislated out and there's been more legislation come in with the Trust Act, which means that being a trustee is just more onerous than it used to be. But there are still certainly tax planning opportunities involving trusts, but it's not slam dunks like it used to be. It's more case by case, and the cost versus benefit isn't always there. Typically, the tax planning opportunities arise when there's one person in the relationship that's earning more than the other. From an asset protection point of view, trusts very much still do have a role to play. Having the family home in a trust is a great way to make sure that if anybody were to come after your personal assets, then, well, you don't have the family home as a personal asset. It's tucked away inside a trust. But disclaimer, not a lawyer, this isn't legal advice. There's all sorts of exceptions and I'm here just to sort of scratch the surface. So, unless the cost of getting those trusts and restructuring debts and mortgages is prohibitive, the most common way that mum and dad small business owners set up a business in New Zealand is to register a limited liability company with 120 shares. Mum and dad each own 1 share each, with the remaining 118 shares owned by the family investment trust. The family home and any other significant personal assets are often transferred to a second family trust. And while this is sort of the gold standard in structuring, it's not always the most cost-effective option. So if you've got structuring questions, leave a comment, send me an email, and I'll get back to you.